Hello everyone, it's Davide here and welcome back to Learning Finance. So first of all, it's finally 2021, so I wish you all a happy new year. And in today's video guys, I'm gonna show you my investment thesis on JD.com. So we are gonna take a look at the valuation of it. I have already done a valuation. If you follow my channel, probably you have seen it. It was with a price to sale ratio, while this time we are gonna do a discounted free cash flows long-term valuation, and then I will also try to give you a price target for it. Okay, so can it be a 3x investment opportunity? We are gonna take a look at that. The only thing I ask you guys is please a nerdy like. It's very important and I thank you for it, and subscribe to the channel so you don't miss any new updates. Let's begin. So if you are new to the channel, what is JD.com? JD.com is one of the largest e-commerce platforms in China, and is actually the largest retail platforms in China with a business to consumer business model. Obviously Alibaba takes more of a market shares because they have multiple platforms. However, JD.com has a respectable market shares of more than 20% in the e-commerce business in China. Huge investors like Dalio from Bridgewater have invested in China also to diversify from the US one, and he bought also JD.com. In their e-commerce space, they have over 441 million users and they sell high quality products. Okay, so what differentiates JD.com from all the platforms? It's that first of all, JD.com makes the fulfillment by themselves, while Alibaba or Pinduoduo, they are more platforms like eBay, okay, where merchants, they can sell directly to consumers, while JD.com is the actual Amazon of China. When you hear people saying that Alibaba is the Amazon of China, that's completely wrong. It is a completely different business. JD.com is the real Amazon of China. Also in terms of competition, okay, they have a really big competitors like Pinduoduo, but if you want quality in the products, if you want fast deliveries, JD.com is the one. Okay, it is very famous also to buy, for example, smartphones. If you want to buy iPhone in China, JD.com is very likely the place for you to do that. While when you go to Pinduoduo or Alibaba, actually the quality of the products, you're looking for a lower quality. You're not looking for high quality brand products. So okay, they have competitors, but they are not exactly in the same niche. That's a thing to keep in mind. Another thing that differentiates JD.com with the other platforms is that JD.com is pretty unique. And why is that? Mainly because of JD Logistics. They have over 800 warehouses all around China. They are unique. They are unique for the simple way that to have these things where you do fulfillment, you have to spend tens of billions of dollars. Okay, so not everyone can actually enter the market and do the same as you do. That's the reason why, for example, there is only one Amazon, and that's what it makes Amazon and JD unique. The moat that they are able to build by investing all this money in the infrastructure is what makes them unique. Okay, differently from other platforms, simple platforms like, for example, Pinduoduo, because to build an infrastructure it takes years and it takes tens of billions of dollars. Another thing that makes the moat around JD.com even bigger is that they invest a lot in technology, and they have been the first firm in the world to actually do deliveries with drones, okay, and autonomous robot machines. If you look at their warehouses, actually it is incredible because JD.com actually has entire warehouses driven by robots, okay, where you have probably just 4 employees doing the same work of 1,000 employees. Okay, so in terms of technology, they are without any doubts the first in their business. They invest a lot in research and development, especially in AI, so to better understand the demand of consumers. And now it looks like that they want to enter as well the world of physical shops in order to be able to reach even the further areas in China, so far away from the big cities. When we take a look at the revenues, we can see that from 2012 they went up parabolically. In just 9 years, went up from 6.7 billion to actually 82.86 billion, and now forecasted earnings are 110.5 billion in 2020 and 137 in 2021. Obviously, as we have seen with Amazon, when you actually want to build an infrastructure, you have to spend a lot of money in it. Basically, everything you get from the business, you put it back to actually reinvest in the business. And this is why over the last 8 years, actually, the net income has been very low and most of the times negative for JD.com. This is something typical of that business. As we can see here, you have Amazon. Okay, look at the net margin. It starts to growing now, but actually over the years from 28 has always been pretty low and even went negative for 3 years in a row. However, lately we have seen a positive net income margin for JD.com, and considering how much they invest in autonomous robots and stuff in their logistic infrastructure, it is very likely that they will be able to scale. Okay, they don't need to hire too many people, so you actually put costs lower as the business goes up. So over the long term, they should be able to scale their business, and this is something you're looking for when you invest in a company. As a Q4, we are expecting one of the best quarter ever, $33.3 billion in revenue. A quick look at their balance sheet, we understand that, as I told you, the margin went positive in 2019. Current ratio, not bad, above 1.20, and then total assets divided by total liabilities 1.73, which is great. Also in terms of debt, 12.36%. However, when we take into account the cash, the net debt divided by the equity goes to zero. So a very strong financial. The market cap is around $131 billion, booked value pretty low, 5.6. Here is in terms to price to sales ratio compared with Amazon. Obviously, Amazon is trading at a higher level, around 3.02, while JD just 1. So this is the price to sales ratio analysis that I did. I don't want to repeat all of that, otherwise the video comes too long. If you want to see the video, is right here. I'll leave you the link down in the description. What we are going to see today is this. It is basically a long-term cash flow valuation, which some hypotheses that I'm gonna explain to you right now. Now, first of all, as we can see, the last quarter we have had a 36% growth in revenue year over year, which around $35.6 billion in the Q3, and a net margin of 4.34. The net margin before in Q2 was above 8%. So this is what you want to see going on in the future. Okay, as you can see, as I told you before, the previous year's net margins were pretty low and then went positive in 2019. Okay, this is because of the huge investments in their infrastructure, which honestly it is something positive for the business. By going forward, I said that the net margin, this is my assumption, so 5% this year, 6.5%, and then going on until 9% in 2028. In terms of growth rate, here I've been pretty conservative, so from 2022 to 2024, 19%. Now just remember that this year they have done 36% year over year, okay? And then 2024 to 28, just 14%. Analysts are expecting, as I said before, 110.5 billion in 2020 and 137 in 2021, and that would be the growth rate compared to the previous year, so 33.35% and then 24%. Considering that China is set up to be the first economy in the world in the next decade, and that the e-commerce is growing at 8% every year, and JD obviously takes more of a market shares as one of the main businesses over there, I think that these growth rates are quite conservative. However, I always want to be conservative when I do valuations. Now, the requirements of the discounted free cash flows, I took 12% as a discount rate, which is pretty high. I want to be sure about it and not put it too low. Perpetual growth after 2028, 3%, which is actually the rate that the Chinese economy will be forecasted to grow after 2028. When we put the free cash flows over there, what we get is actually today's company valuation of 286.6 billions divided by the shares outstanding, the fair price 184.9, so almost $185 per share. Considering that the price today is 87.7, that means that the stock is currently 52.58% undervalued, so that the stock could more than double just to reach its fair price. Okay, so that's something to keep in mind. A very undervalued stock considering its fundamentals. And why is that? Mainly because people are afraid of the threats going on with the Chinese government and the e-commerce space. Okay, so what we have seen with Alibaba, investors in the short term are not very confident. So these kind of stocks are pretty cheap. However, in terms of business itself, you have the numbers, and the numbers are real, and this is the situation right now. So differently from other stocks, like for example startups and stuff that basically you are investing in dreams, here you have the real numbers and they are going on right now. That's something to keep in mind as well. To give a price target, I took the 2028 revenue with the growth rates that I just showed you before. The revenue will be 389.9 billion, and then the net margin 9.5% in 2028. That will be the net income. By taking a PE ratio of around 17, now considering that stocks like Apple are still trading above 30, even though they have reached maturity, as well as Google, Microsoft and stuff, I think that a 17 PE ratio, it is acceptable. The market cap at that point, it will be 629.7 billions. Considering that today is just 131, that would be a 380%, so almost a 4x on the market cap. By considering a little bit of dilutions with shares, similar to what Amazon has done, that would be the target price, okay? So $359.8 by 2028. Considering the price of today, that would be a 3x even more on the stock price, and on average a 44.33% return year over year. Now this is pretty high. Now I know that after 2020 we think that all the stocks are gonna do 3x in 6 months, but actually if you look at the history of the stock market, it is not like that. 2020 has been a crazy year, but it's not gonna last forever, and a 44% return year over year, it is something very appealing for the stock market, considering that on average it does around 9-10%. Now obviously this is a 3x opportunity by being conservative, because I like to be conservative. If we actually go there and try to put these things a little bit more optimistic, considering that JD this year and the next year is forecasted to do on average around 30%. 28%, and let's just put, for example, a 22 until 2024, and then here let's put 16. Okay, so a more optimistic scenario. In that case, the revenue will be $450 billions in 2028. Same stuff. We will have probably a PE ratio a little bit higher due to the higher growth rate, let's say 18, and that will give us a return of the market cap around a 5x, a price target of around 440, and a 4x on the investment. Okay, by starting today. In 7 years, that would mean 57.4% year over year. So this is the more optimistic one. Obviously, I remain stuck with the previous one, to be conservative, but this is something that it's possible. Okay, if it happens, it is a plus on our investment. So as you know, I own shares of JD.com and I remain pretty positive over the long run despite short-term threats by politics, which I think they will go away in the long term. When we take a look at technicals, we see that recently JD.com actually just broke that level, that downtrend line, basically was stuck in this triangle and then broke up 2 days ago, and now is trading at around 87.9, confirmed on the day of yesterday. So today the market is closed. However, this, even from the technicals, it remains pretty positive. So here you have my investment thesis on JD.com. I hope you find this video interesting, guys, and leave me a like and leave me a comment below. Tell me, what do you think about that? Subscribe to the channel, and as always, guys, have a wonderful day.